Thanks for joining us today. For those who haven't crossed paths with me yet, I'm Saurabh. I'm a senior data scientist with Amazon. And yeah, we all know the reality of our compensation structure. RSUs is a big part of wealth building, but they also create a lot of heavy tax liabilities if you aren't strategic about it. Um, Outside of my day-to-day work, I run a real estate firm, basically invest properties, buy, and then have them rented out. So that creates a lot of tax liabilities. And as my own portfolio grew to multiple properties, I quickly learned that earning the money is only half the battle. Um, the other half is actually deploying it efficiently and shielding it from the IRS. So this is I spend a lot of time, thinking and optimizing for this tax aspect of wealth building. Recently, I was at a startup event focused on real estate and connected with a bunch of founders and co-founders. One of them was Alphanso AI, and we got to talking, and I was genuinely impressed by their sophisticated approach to tax planning, specifically tailored towards high-income tech professionals. I realized that this is exactly the high-level kind of strategy to use uh, that this network needs. So I have asked them to come in here and share their playbook with you. I'll send out a follow-up email later on, but for now, let's get to the main event. I'll hand over the floor to Brian and Rupesh and let them take over.
Hi, guys. Thanks, Sarah, for introducing us and giving us the stage today. Now, as Sarah mentioned, we're here to discuss the riveting topic of tax mitigation and how it relates to investment strategies. Now, I know this is a very exciting topic, so we have installed an electric shock feature. So we'll periodically use that to make sure everyone stays awake today. And just to give you a little background on myself, so my name is Brian Kirby. I'm the lead here at Alphanso Wealth. I have over 20 years experience in advisory. I began my career as a retail advisor with Merrill Lynch. After a few years, I moved to the institutional side where I worked on mega corporate plans. I was one of the managers on the Apple plan, as well as government 457 and 403B nonprofit plans. I also have extensive experience in executive benefit and liability planning. So any questions you have on that, we'll be happy to put in the QA and I'll be happy to help answer those. Our goal in today's presentation is to share insights that have worked for employees at big tech companies like Amazon. Now, we'll try and keep this practical, focusing on real-world applications. By the end of the webinar, you will walk out with an actionable item for tax mitigation and diversification, especially during high RSU years. Joining us today is today's speaker is Rupesh Goyal. Rupesh has over 10 years experience in portfolio and hedge fund management, where he managed assets in excess of 300 million, consistently beating benchmarks. He has an MBA degree from the Carroll School at Boston College, is an active member of the CFA Boston community. Now, we want to keep this session interactive, so there is a Q&A button at the bottom. So please, as we go, if any questions pop up, put those questions in the Q&A and we'll answer that right after the presentation. Thanks for joining us. Let's get started. And Rupesh, over to you.
Thanks, Brian. Let's get started with the life story of Mike, who is a hardworking software engineer at Amazon. He's married, he has kids, and he lives in Seattle. His household income is $500,000, and this year, it's going to be a big year for him with $200K worth of RSU vestings. Now, he has some challenges at hand. First, given his RSUs are taxed at an ordinary income at vesting, Mike's federal tax liability will most likely exceed $125K. Second, his portfolio is already concentrated with more than 30% of his portfolio in Amazon stocks, which gives him stress during quarterly earnings. And lastly, on tax day, he's looking to pay additional $3,000 in IRS penalties because he was busy with his life and missed quarterly tax payments. This combination of high RSU income, tax under withholding, and stock concentration is exactly what we call peak vesting year planning problem. This isn't just an inconvenience for Mike, it also means potentially leaving tens of thousands of dollars in tax savings on the table if he doesn't take actions this year. So how should Mike go about all this? That leads us to the agenda of today's webinar. We'll discuss how Mike can take three-pronged approach to address these challenges effectively. First, by going offense, which is all about proactively making moves to reduce his taxes. Here, we would discuss some of the strategies that can help Mike reduce his 125K tax burden to a much lower amount. Second is building a strong defense, which is all about protecting the wealth which he has already built. Here, we would discuss some strategies that can help Mike reduce the concentration risk without triggering any major tax events. And lastly, the foundation strategy, which is all about taking a structured and hygienic approach. Here, we would discuss strategies that will keep his future safe and maintain a good financial hygiene and avoid any penalties. By end of this session, you will have a very clear framework for turning high income years into long-term wealth building opportunities instead of tax and stock volatility headaches. So let's get started with the first offense strategy, which is direct indexing and tax loss harvesting. Normally, when you invest in the market, you probably would be buying ETFs such as S&P 500's SPY, tech stocks QQQ that tracks this particular index. While it is simple to execute them, it is not very tax efficient. Then enters direct indexing. With that, instead of buying this one whole fund, you are actually buying individual stocks that make up that index. For example, in case of QQQ, when you don't buy the ETF, you buy the 100 stocks that make up that particular ETF. And how is that helpful to you? At any point in time, not all stocks in this ETF would be up, even if that index is up in aggregate. And what you can do is you can sell those stocks to capture the loss for your tax purposes and buy either similar stocks related to them or buy them back at a later time. Those losses then can be used to offset the capital gains that you incurred when you sold your RSUs or when you sold your other investments, or reduce your taxable income to a certain extent. The key part here is that you stay invested in the market. You're not changing your long-term strategy. You're just making the portfolio more tax efficient. Think of it as turning normal markets ups and downs into tax savings, which you just can't achieve by investing in ETFs. Let's see how Mike will take advantage of this strategy. Now, Mike has an investment portfolio of $300,000 and his tax bracket is 37%. Through direct indexing and tax loss harvesting, Mike's portfolio generates $40,000 in tax losses for that year. And those losses then help him offset taxable gains and his income, resulting in tax savings of over $8,500 here. The next offensive strategy is oil and gas investing. These investments typically involve participating in energy and drilling projects that generates oil and gas. One of the main reasons to consider this strategy is their preferential tax treatments given by the US government. And why would they do that? Because the government recognized the growing need for energy resources and they aim to become more self-sustaining while increasing the production so that they can support the economy. And why do we think that it may be the best time to invest now? That's because AI has created a massive need for energy. And now more than ever, we need all kinds of resources to obligate those needs. On top of that, current geopolitical environment, which we are all very much aware of, supports the prices for these commodities. Why? Because the supply constraints still remain prevalent. In terms of the benefits for investing this via this strategy, the majority portion of the investments can be used for tax deductions immediately from your active income. That means you will be able to reduce your taxable income in the same year that you invest. In addition to the tax benefits, these investments can also provide you passive income with potential diversification, since energy markets often behave differently from the broader stock markets. The key risk is including dependence on oil and gas prices, which can be volatile just like the stock markets. So while this can be a very, very powerful tax planning tool, it should always be used as a broader, diversified strategy, not, let's say, as a core portfolio holding that you would invest in. Let's see how Mike will take advantage of this particular strategy. Let's say Mike decides to invest 100K in oil and gas project that qualifies for this immediate deduction, and his tax bracket is around 37%. Because now the investment can be written off in the first year, this will directly translate to $37,000 in tax savings for him. On top of that, he stands to generate additional 100K of total income over the first 3 years of production, which reflects a very strong early return profile for him. And after that, the investments will continue producing around $5,000 a year for him, creating an ongoing passive income opportunity for him. With a project lifetime of about 20 years, this structure then becomes a very powerful combination of upfront tax deductions, early income generation, and long-term cash flow for Mike. The next offensive strategy is investing in solar energy and EV charging infrastructure projects. In such projects, you participate in either energy generation, which is via solar installations or EV charger installations. These projects are supported by US credits and government incentives, which are designed to encourage investments in the renewable energy and electrifications, which are, as we know, are the areas that continues to grow significantly because of climate changes and obviously due to the coming years' energy needs. To enhance the tax returns, these projects often all take the leverage, which could be around 1x to 3x of the investments you make. So when we look at the benefits from tax perspective, investors benefit from tax credits and deductions that they generate from these investments, which reduces their overall tax liability. And any investment made is also generating a passive income and a diversified portfolio, since this performance is not directly tied to the stock market performance. One important requirement here to understand is the active participation required in this particular project. To maximize tax benefits, you typically need to demonstrate meaningful involvement, which is often around 100 or more hours a year. However, if you're working with the right set of people, you can easily achieve this even with a busy lifestyle. Let's see how Mike will take advantage of this strategy. Again, Mike decides to invest 100K in this solar project that qualifies for immediate deductions and tax credits, and his highest tax bracket is 37%. The project also uses a leverage of 1.5x, that is 150K in finances, which increases the total project size to 250K. Now, this whole amount can be actually written off in the first year along with the tax credits, which will translate into 140,000 in tax savings for him. That is 140% returns in just the first year for him. After the initial credit period, the project will then generate an ongoing income of around $3,500 a year after all the expenses incurred by this project, creating a modest but a steady passive cash flow income for him. With a projected lifetime of around 20 years, this structure becomes a primarily tax-driven upfront investment for him, followed by a long-term passive income generation. The next offensive strategy option for him is the short-term rental real estate, or we call it as STR investing, which Saurabh also alluded to in the beginning, which is similar to operating an Airbnb style property. With STRs, you are not just owning real estate, you are effectively operating a small hospitality business, which opens door to unique tax advantages. One of the most powerful is the bonus depreciation on the property. What that entails is you can deduct all the value of the assets that qualify for bonus depreciation in the very first year of the property purchase. That amount is generally higher than the investments you actually made that year. And that is because you'll also most likely take the mortgage on that property. What that means is SDR investments can potentially help reduce taxable income while still owning and appreciating assets. In addition to tax benefits, SDRs can also provide a rental income stream and diversification out of the stock market. However, there is a important consideration here. Returns are dependent upon obviously travel demands, the property location, and the real estate market cycles. And similar to solar and EV, there is an active participation which is required here, which is often around 100 hours a year to fully benefit for the tax treatment. Let's see how Mike will take advantage of this strategy. So Mike decides to purchase a property for about $450,000 with a total upfront investment of 150K. That includes the down payment needed and the renovations needed to prepare this property for short-term rental use. Now, through bonus depreciations, this property will generate 135K depreciation deductions in just the first year for him. And given his 37% federal tax bracket, that translates into $46,000 roughly in immediate tax savings for him. In addition to that, from a cash flow perspective, his property on average produces about $24,000 a year in net income after accounting for all the taxes, expenses, and the loan payments. Unlike structure projects like EVs, oil and gas, that has fixed timelines, real estate has no defined timeline. So the investments can continue to generate income and your property can get appreciated as long as you hold this property. The list doesn't end here. There are several additional strategies that you can implement based on your preferences and financial situation. In the interest of time, we won't go in detail of each of them today. What we can do is after the webinar, we'll be sharing supporting materials so you can learn more about them yourself or talk to us about them. So let's move on to the defense strategy now, which sheds a light on how to diversify from the concentrated position without taking a tax hit. Now, after this year's vesting, Mike's Amazon holding will be 40% of his portfolio. And that worries him how things have been given recently. He saw that recent AI tooling announcements from Claude have shaken the software sector significantly. And even the companies which are well established like Adobe's, ServiceNow's, Workday have fallen more than 40% from their peaks. He also saw news around Coupang, which is the Amazon of Asia, go down by more than 40% after they had a data breach, and that led to fines from their government. This has a telling that even strong, well-established companies and even the entire industry can experience sharp declines, often due to technological shifts, competition, regulations, or changes in the market expectations. So what can he do? So the simplest diversification strategy he can do is selling RSUs at West. The important thing here to remember is that RSUs, which you get, are already taxed as an ordinary income. So when they vest, they don't so after they vest, they don't generate any income if you sell. The proceeds can then be used for reinvesting in a diversified portfolios, such as ETF investing or direct indexing strategies. The key benefit here is simple. You reduce your concentration risk without creating additional taxes which makes this one of the most cleanest and most efficient diversification strategies during these high vesting years. It is important to note that if your Amazon holding is more than 20% of your portfolio, you seriously need to consider the diversification, because anything above that creates a concentration risk, which, as we all know, can be unpredictable and severe in these markets. Another way to diversify from a concentrated stock position is to sell the most efficient lots first. So instead of selling everything at once, which you did when the stock's best, you can gradually diversify in a tax-aware way as well. What this means is selling shares in a very specific order, starting with, let's say, shares which are already at a loss, or when the cost basis for them is very high, or if they have a long-term capital gain, which is generally lower than the short-term capital gain. The proceeds from these then can be reinvested into a diversified investments such as ETFs or direct indexing to maintain the market exposure while lowering the single stock risk. So let's take a look at how Mike will approach selling his stocks that he holds from Amazon. So let's say current share price is $210 and one of his shares at $190 and the other in January at $170. The gains on the respective lot per share is $20 and $40 respectively. Now, to figure out which lot to sell, Mike did math and found out that if his income tax rate is less than 40%, then he will sell the September lot. And if it is greater than 40%, he will go for January lot. He called his CPA and he asked for his tax rate return, and turns out it was 37%. And that makes September lot the winning lot for him to sell and diversify. Another way to diversify the concentrated stock position without triggering an immediate tax bill is through pooled funds. So what are pooled funds? Pooled funds is when many people put their stocks, such as Meta folks, Apple folks, Google folks, together in one big investment pool that is managed by professionals. So instead of selling your highly appreciated stock like Amazon shares for diversification, what you do is you contribute your shares into a pool fund, which is run by professionals who also onboard other investors who had similar concentrated positions in other stocks. In return, you receive diversified portfolio of stocks, which helps you reduce the single stock risks immediately while also deferring your capital gains. Overall, how it helps, because now you are not selling your stock, there is no taxes that incurred from this strategy. And on top of that, you are diversifying your Amazon stocks with other investments. And since the tax gains are also deferred, most of your money stays invested and it's getting compounded over time, which can be a meaningful long-term advantage for your portfolio. But that said, there are a couple of important considerations for something like this. These funds typically come up with a liquidity lockup period because of their complex structure. And it also includes incur additional fees, which could range from anywhere from 0.5% to 2%, which is relatively high compared to traditional investments or any ETFs that you would invest in. So now let's move to the last part of our webinar, which is about the foundation strategy that involves making most of you out of your existing investments and avoiding RSU underpayment penalties. Let's first talk about the importance of integrating your investments and taxes. When we talk about investing, we generally focus only on returns. That is how much of your portfolio has gone up. That's what matters most. But in reality, investment returns doesn't exist in isolation. What truly matters is what you keep after taxes. Two portfolios earning same market returns can produce very, very different outcomes depending upon how efficient the tax strategy was. So when the investments and taxes are integrated, three powerful things happen. First, you can achieve higher tax after tax returns, not by taking more risk, but by being smarter about your asset allocations, tax loss harvesting, and withdrawal timing. Second, you benefit from most efficient compounding because the money isn't lost to unnecessary taxes and it stays invested, it continues to grow over time. And lastly, you avoid unpleasant IRS surprises like underpayment penalties, unexpected capital gains, or large tax bills during your high income years. Let's say how Mike benefit from integrating his taxes and investments. So Mike had 150K sitting in his savings account that was earning 3.3% returns. That interest is fully taxable at his 37% federal tax rate, which significantly reduces his real returns that he keeps. Now he got to know about municipal bond, which was yielding 4% at that time and had a very similar risk profile to that of his savings account. Now, because the municipal bond, the interest on that is federally tax exempt, Mike keeps more of what he earns here. Even though the difference in returns of 3.3% versus 4% seems minimal, the after-tax impact is meaningful for him. With just one quick switch, Mike ended up saving $3,165 in addition by choosing a more efficient tax option. And he doesn't stop here. He continues to apply the same tax-aware approach through tax loss harvesting and through thoughtful portfolio allocation, which can eventually help him save tens of thousands of dollars over time. And lastly, let's talk about the basic hygiene check, which often gets overlooked, especially during your high RSU years. When RSUs vest, companies typically withhold around 22% of your federal taxes, which works as a baseline for your withholding. But for many of the high income households, that actual rate is much more higher than what actually you are paying, which creates a shortfall. And that's where the estimated payments comes in. Making quarterly estimated payments help bridge the gap between what's being withheld and what you actually owe. The IRS provide something called a safe harbor rule to help you avoid those penalties. Generally, you are protected if you either pay 110% of last year's total tax or you pay 90% of your current year's total taxes during your fiscal year. The goal here isn't to pay taxes early, it's simply to avoid the penalties and interest during these high RSU years when RSU vesting can significantly increase your tax liability. So how did Mike go about it? Given he's very busy, he called up his CPA and asked him to estimate his quarterly payments. And once he got the number, he avoided any surprises with his tax bill on that April 15th day. So to summarize all, the goal during the high income and high RSU years is to be intentional about both taxes and your investments. First, you can minimize taxes through tax deductible investing strategies. Second, you can reduce your concentration risk, especially when a large portion of your income and portfolio is tied to a single stock through tax-aware selling and pooled investing. And finally, you can avoid penalties and be most tax efficient with proper integration of your investments with your taxes, along with accurate tax estimations and safe harbor planning. When all of these pieces come together, high income years become the best years for you in terms of building long-term wealth and creating opportunities for your future. Remember, Mike turned his 200K vest RSUs, which was going to cost him a lot in taxes and penalties, into a structured plan that reduced his tax bills and lowered his overall portfolio concentration risks as well. And so can you. So what can be the next steps for you? If you already implemented 50% of these strategies, kudos. You are dangerously close to becoming everyone's unofficial financial advisors. If not, we will provide you a toolkit to help you implement these strategies so that you can do them independently, or you can book a session with us to handle the executions for you. With that, I'll pass on the mic to Brian for his concluding remarks.
Great, thanks. That was a lot of information, Rupesh. I hope the session was helpful for everyone. I know it can be a lot to take in, but please, I want you to share any questions you have with us. We have the Q&A button at the bottom of the screen. You have a bunch of questions that already came in, so we'll start with those. But please continue to ask, and Rupesh will handle all of those for you. So, Rupesh, our first question is, are RSUs taxed at fair market value?
Yes, so RSUs are taxed actually at ordinary income rate when they are vesting, which is based on the fair market value of the shares at that time. Any later gains or loss after that vesting is taxed at a capital gain or losses depending upon how the price goes about after the vesting.
Great. What happens if I swap shares with SPY right after vesting?
So, good question. So when you kind of swap your shares with, let's say, a S&P 500 index after vesting, you are incurring no capital gains on that particular period. So what you are necessarily doing is you are reducing your portfolio concentration from Amazon, and you are diversifying your investments into a diversified ETF, which bodes well for your long-term investing and wealth building strategy.
Now, can I choose what kind of funds I invest in with direct indexing?
Yes, generally, if you are working with sophisticated financial advisors and companies, they would give you multiple options to invest in based on your existing investments and based on your risk profile. So let's say if you want to invest in technology sector in specifically, they can build a direct indexing strategy around, let's say, an ETF called QQQ. Or if you want to be very, very broad, you can go for S&P 500. Or if you even want to do international direct indexing, you can go for an index like EFE. So yes, so based on your existing holdings and based on your risk profile, you can choose the direct indexing strategy that works for you.
Okay, next question is, so the first strategy was to swap ETFs with individual stocks. I don't think I followed how to harvest losses.
Okay, so here is how it works. So let's take example here. Let's say you went for S&P 500 ETF here. So rather than with direct indexing, what you are doing is you are buying all those 500 stocks rather than the S&P 500 index ETF. So now year ends and S&P 500 was up 10%. You won't be able to do any selling without incurring capital gains if you had an ETF. But let's say you purchased 500 stocks in that particular index. Now, not all those 500 stocks went up during that year, right? On an average, you would see 60% of the stocks go up and 40% of the stocks go down for that particular year. That's where you would capture those losses. So you sell those 40% of the stocks and you either purchase them later or buy similar stocks. And that's where you kind of capture the losses while still maintaining your exposure to the broader ETF.
Okay. Next question is volatile oil and gas pricing the only risk factor in this investment?
Yeah, the risk in oil and gas is often more about liquidity and timing than actually, the complete loss of your principal. It's just like stock market. So unless a company goes bankrupt and disappears, oil and gas is the major reservoir that remains here. So for example, if the prices drop below the break-even threshold, which the company calls at which they operate and they shuts down, what they do is they would just switch off the production until the prices recover. And once the prices recover, they would start generating this oil and gas, which would generate the income for the user. So in short, yes, the major risk for these particular investments is the volatility. There can be other risks which may be not visible. Let's say if some natural calamity happens during that particular place. So that's something which is very, very rare. But obviously, in terms of general general kind of losses we are looking at for volatility in oil and gas prices remains the primary one here.
Okay. Uh, are non-US citizens and non-permanent residents eligible for tax loss harvesting?
Yes, they are. Again, very standard through direct indexing, or if they are doing it on their own, they are absolutely eligible to do something like that on their own or have someone else do it for them.
Okay. So back to oil and gas. One person asked, how did you get 37 a tax deduction of 37K in oil and gas investment?
Okay. So that came from 100K of investing. We took an example of Mike. So given his tax bracket at a federal level was 37%, what he did was when he invested 100K in the project, he was able to reduce his W2 income by exactly that amount. And then once he kind of reduced that amount, that kind of equate to 37% of his tax bracket, which comes down to exactly $37,000 per year.
So sticking around the oil and gas sector, if the energy market price crash, what happens to my principal?
Okay. So if they were to crash, it's pretty similar to what would happen if, let's say, tomorrow stock market were to crash. While you still hold interest in that particular company, your returns are kind of depressed. So that's something would happen in an oil gas investment. So prices go down, your kind of shareholding holding in that project remains, and they won't be kind of producing that much because they don't want to sell oil at such a lower price. So your income would go down, and once the prices recover, they start generating they start the project again, and they start generating oil and gas that results in continuous income stream again for you.
Okay. The, the strategies that require active participation to qualify for tax benefits, is it realistic for a full-time employee on a W-2?
Yeah, it is very much realistic, but it actually requires very specific administrative related strategy. So for a full-time employee, the goal here isn't just to kind of work, but also to kind of document and structure it in a way that shows the material participation. Some of the activities that counts towards the kind of active participation here is the due diligence which you make, which could be even this call which you are attending, the operations work like reviewing the statements and the reports generated from them, attending meetings around that particular project, and general purpose reading that enhances your ability to understand these things even better. So those things all kind of count towards your active participation.
Okay, yeah, the threshold is low for actual hours. So, like you said, this meeting counts for 1 hour of your time.
Exactly.
Yeah.
So and in total, if you were to kind of do, it's like just 2 hours a week. That kind of equates to almost 100 hours a year.
Now, sticking with that theme, can I hire someone for Airbnb 100 hours?
Okay. Yes. You can hire someone to have a job for you. And you can still claim bonus depreciations to offset your active income when you are kind of running this Airbnb kind of style project. But that only can happen if you still remain the most active person involved. So the criteria here is you need to satisfy that no one else has spent more hours than you on this particular project, and that you need to kind of spend 100 hours on this particular project. So in this case, if you hire the person, you should be the one who should be actively managing that particular person, and that should kind of equate to more than 100 hours of your time, basically, and it should be more than what that person is kind of spending on your job actually.
Okay. What
I
you're saying
yeah.
is if you hire somebody and you provide management oversight, those hours are included in your 100 hours.
Exactly.
Okay. Um, so next question
Sorry.
is, I'm
I
sorry, go
was
ahead.
I was going to add that you can hire someone, but also remember that, any company. So I own some short-term rentals,
Uh-huh.
and I bought them mainly for, to get some good cash flow, but also to offset some taxes. But when you're adding a new person in for managing the rental, they usually charge like 30-40%. A long-term rental, someone managing that charges like 8 to 10% of the overall revenues, versus a person who's managing a short-term rental, since it is more involved, charges 30 to 35%, which eats into your cash flow. So
Yep.
this is something that you would want to consider as well. And yeah, what Rupesh said, that you need to be the one who's putting in the most amount of active work.
Great. Okay. So thanks for that, Sarah. That's great information there. So 20% of portfolio. Can you please expand what includes this portfolio? Brokerage, 401k, cash, HSA, etc.?
Everything that kind of is part of your wealth apart from your residence where you are kind of living. So you kind of pointed out correctly your 401ks, your HSAs, your IRAs, brokerage accounts, even your savings, those kinds of things all count towards your overall portfolio.
How can I ensure my stocks are safe in the pooled funds? What are the typical fees?
Yeah, I mean, exchange funds are significantly more expensive than an index fund or ETFs, and that's because of the legal and the administrative complexity that is associated with sweeping thousands of different stocks into one particular pool. So the annual management fees we are looking at is roughly 0.5% to 2% of your total investments, depending upon the strategy and the advisor you kind of choose. The money is generally safe as these fund managers are registered investment advisors with SECs or their respective states and have custody in prime brokerage companies, let's say JP Morgan and Schwab, where standard SIPC insurance is still applicable that covers roughly 500K of your investments.
Okay, so in order to avoid tax payment penalty, we can make payment till December 31st of that year, or is there a grace period?
Sorry, I was cutting out a bit. Brian, can you repeat?
Oh, sorry. So it's in order to avoid tax payment penalty, we can make payment till December 31st of that year, or is there a grace period?
Typically, you need to do it every quarterly rather than December 31. So IRS has set a dates for every quarter that you need to kind of pay for. So for example, whatever income taxes that you owed from January 1 to March 31, you need to pay it by April 15. So similar for the next quarter and for last quarter, which is from September till December, you need to pay it by January 15. So ideally, you should be kind of doing it every quarter.
Okay. So next question is, if I ever decide to get out of direct indexing, isn't it going to be a painful process?
I mean, painful in what way? So generally, it's very similar to that of ETFs. So example, if you want to kind of come out of ETFs for selling for, let's say, any home purchase or anything else which is kind of coming up, you would need to pay taxes. The same goes with direct indexing. So let's say if you want to kind of liquidate the position because you want to either invest somewhere else or you want the money for any particular upcoming goals or requirement, you would need to sell it and pay taxes on that. So it's very, very similar in terms of the tax liability, so whether you kind of are in the purchasing the ETFs or purchasing the direct indexing fund. The benefit actually for that is the losses which you incurred from selling those stocks. That is something you can still use to offset the gains which you kind of received from selling those stocks as well. So just to add to that, it's actually still beneficial to sell everything if worse when you kind of compare that with an ETF.
Okay, and on that same topic, so the suggestion is to buy 500 individual stocks to capture losses.
That's correct. If you are purchasing the ETF, which is S&P 500, it's better to kind of go for purchasing those 500 stocks individually and then recuperating losses at any given point of time.
Okay, so you talked about some of the tax saving strategies requires minimum numbers of hours. Is it an option for people on visas such as H-1B or L-1?
It totally depends upon the kind of visas that you hold. Some of them might be harder to kind of do it. So, for example, the active participation, which we are kind of talking about on an H-1B for you would be hard because that means you are running another business, right? So that's something you won't be able to do while you are on H-1B. But the other strategies, let's say like direct indexing and oil and gas investing, that is something you can take the best benefits because there you don't need to kind of show in any active participation to gain the tax benefits. So it totally depends upon the kind of visas you are in and what's your status, and the strategies are kind of applicable accordingly to you.
Yeah, so essentially, there is a strategy for everybody. It's just you choosing the right strategy based on your current situation.
Exactly.
Okay, so Madhu asked, is quarterly tax payment the only option? What if we increase the default RSU taxation percentage from 22%?
You can do that. The next big withholding rate is 37%, and that is generally higher than what you actually need to pay taxes on. So what that means is you are actually loaning free money to IRS. So we highly recommend rather than giving the free loan to IRS, you do the estimated tax payments and you do the remaining of your investments in a strategic way, whether it could be like direct indexing, ETF investing, or even savings investing that would give you some return versus the IRS free loan, which won't give you anything.
Yeah, I mean, and as you mentioned, tax mitigation is a big topic for us. So we are adverse to giving free loans to the IRS. That's 100% correct. Okay, so for the oil and gas, are we investing in specific oil wells or to a company which owns multiple wells? Asking this as you talked about 20 years of investment horizon. But what sort of depreciation happens to the initial investment? Also, what kind of tax benefits one can avail after year one?
Okay. So let's break it down in three parts. The first is the investment part, whether you would be investing in a single project or multiple projects. So generally, it could be both. It depends upon what you choose. But what generally we have seen works the best is when you kind of invest with a single particular project that has multi wells. So there is well one, which has different kind of dynamics in terms of, let's say, 60% oil, 40% gas. There is another well which has a different composition and different geography. So they have like these different wells. So that, let's say, diversifies the income streams that is kind of generating from each project. So that's the first one. The second is the tax benefits that you would receive after year one. So yes, there are more tax benefits after the year one, which is the tax deductions you did. So after year one, whatever income you are generating, only 85% of that is actually taxable and 15% of that is tax free. So for example, if you generated $1,000 in income from these particular projects, Only 850 of that will be taxed, and 150 is completely tax-free for you. What was the another question within that question, Brian? Sorry, forgot.
So
The
what sort of
taxes.
depreciation happens to the initial investment? Also, what kind of
Right.
tax
So
benefit? Yep.
right. Yeah, got it. So in terms of appreciation and depreciation, it's not an asset that you owe in these kinds of projects. So you are basically owning a kind of partnership in this particular project. So generally, your money, if you want to be most tax efficient in this, goes actually into operations of these particular projects. So not owning everything as a tangible assets in this, it's more like a partnership. So there is nothing to appreciate or depreciate in your kind of position. It's all about having that partnership, and that partnership generates oil and gas, and you get royalty out of it.
Okay, and the final on that one was what kind of tax benefits can
Yeah,
one
I think that's covered.
expect
Yeah,
after year one?
it's the income. So whatever income you generate, 15% of that is tax free and 85% is only taxed.
Okay, great. So that's all the questions. Rupesh, thanks again for answering that for us. Um, we covered a lot of ground today. So from the nuances of RSU investing to more complex like pooled funds, tax loss harvesting. Now we know this is a lot to digest in one sitting. You know, especially if you guys are trying to balance a full-time role at a place like Amazon, it's not easy. To make this actually useful for you, we put together a tax mitigation toolkit. You can find that in the link. It's going to be right here in the Q&A box. So inside, we've included a calculator so you can run your own numbers. We also added the full slide deck from today and a recap video if you want to revisit a specific strategy. Um, we've opened up a few one-on-one slots next week for Amazon RSU sessions. Those are going to be one-on-one sessions. It's going to be a screen share where we look specifically at your vesting dates and see what strategies that we talked about today, in addition to other strategies that we have available to see what ones can apply for you guys. So I want to thank everybody for the time today. Great questions. We look forward to continuing the conversation. I hope everybody has a great week. Be productive, get out there and have fun for the weekend. And I look forward to talking to you all very soon. Bye, everybody.
Thank
Thanks,
you.
everyone.